and Brazil's oldest bank's Petrobras Kickback scheme. In the gleaming financial districts of São Paulo and Rio de Janeiro, where glass towers house Latin America's most powerful banking institutions, few names carry the weight and prestige of Banco do Brasil. Founded in 1808 by Portuguese Prince Regent Dom João, this institution didn't just witness Brazil's transformation from colony to economic powerhouse, it helped finance it. For over 2 centuries, Banco do Brasil served as the country's financial backbone, managing government accounts, financing infrastructure projects, and growing into Latin America's largest bank by assets, with over $850 billion under management by 2014. But beneath the marble floors and mahogany boardrooms of this venerable institution, a corruption scheme was brewing that would shake Brazil to its core and implicate the nation's oldest bank in the largest corporate fraud investigation in Latin American history. When federal prosecutors began unraveling what they called Operation Car Wash in 2014, they discovered that Banco do Brasil wasn't just a bystander to Brazil's corruption epidemic, it was an active participant in a kickback scheme that would ultimately cost Petrobras shareholders over $20 billion and send shockwaves through the global financial system. The Petrobras corruption scandal, known locally as Operação Lava Jato or Operation Car Wash, began with a simple money laundering investigation at a gas station in Brasilia, but quickly evolved into something far more sinister. Federal prosecutors discovered that Brazil's state-controlled oil giant Petrobras had become the epicenter of a massive kickback scheme involving construction companies, politicians, and financial institutions. The scheme's mechanics were elegant in their simplicity, yet staggering in their scope. Construction companies would inflate their bids for Petrobras contracts by 10 to 20%, then kick back a portion of those inflated payments to Petrobras executives and politicians who approved the deals. Between 2004 and 2014, this systematic overcharging cost Petrobras an estimated $2.1 billion in direct losses, while the total economic impact reached over $20 billion when accounting for inflated project costs and misallocated resources. At the center of this web sat some of Brazil's most powerful construction companies: Odebrecht, OAS, Camargo Correa, and Andrade Gutierrez. Firms that had built everything from Olympic stadiums to hydroelectric dams across Latin America. But executing a fraud of this magnitude required more than just corrupt executives and compliant politicians. It demanded sophisticated financial infrastructure to move, hide, and legitimize billions in illicit payments. That's where Banco do Brasil entered the picture. As Brazil's largest government-controlled bank and the primary financial institution for federal agencies, Banco do Brasil found itself uniquely positioned within the Petrobras ecosystem. The bank managed numerous Petrobras accounts, processed payments to construction contractors, and facilitated international transactions for the oil company's global operations. This privileged position gave bank executives intimate knowledge of Petrobras's financial flows and unprecedented access to confidential contract information. Federal investigators discovered that Banco do Brasil employees had leveraged this access to facilitate money laundering operations and, in some cases, profit directly from advanced knowledge of Petrobras deals. The bank's international correspondent banking relationships proved particularly valuable to the scheme's architects, who needed to move money across borders to offshore accounts in Switzerland, the Cayman Islands, and other traditional money laundering havens. Banco do Brasil's reputation and regulatory standing meant that transactions processed through the bank attracted less scrutiny from international compliance systems, making it an ideal conduit for disguising the proceeds of corruption. Between 2009 and 2014, the bank processed over $800 million in transactions that prosecutors would later identify as connected to the Petrobras scheme. Transactions that should have triggered multiple compliance alerts but instead passed through the bank's systems with minimal oversight. The investigation revealed that Banco do Brasil's involvement extended far beyond passive facilitation of suspicious transactions. Bank executives had actively participated in the scheme by providing confidential information about Petrobras's financial condition and upcoming contracts to co-conspirators. This intelligence proved invaluable to construction companies seeking to optimize their bidding strategies and to money launderers planning their operations around Petrobras's payment schedules. In exchange for this information and for their cooperation in processing questionable transactions, bank employees received millions in kickbacks, often disguised as consulting fees or inflated service contracts. The bank's internal audit systems, which should have detected these anomalies, had been systematically undermined by corrupt executives who either suppressed suspicious activity reports or ensured that cooperative compliance officers were assigned to oversee Petrobras-related accounts. Perhaps most damaging was the discovery that Banco do Brasil had actively marketed its services to construction companies involved in the scheme, promoting specialized financial products designed to facilitate rapid international transfers and complex multi-jurisdictional transactions. These products, marketed under the guise of legitimate trade finance, were specifically structured to evade Brazilian capital controls and international anti-money laundering protocols. When Operation Car Wash prosecutors began making arrests in March 2014, the investigation's scope seemed limited to a handful of corrupt Petrobras executives and their immediate co-conspirators. But as investigators followed the money trails and gained cooperation from early defendants, the true magnitude of the scheme became apparent. By 2015, over 100 people had been charged, including some of Brazil's most powerful politicians and business leaders. The investigation revealed that former President Luiz Inácio Lula da Silva had received luxury apartment renovations and other benefits worth over $1.1 million from construction companies involved in the scheme. President Dilma Rousseff, who had chaired Petrobras's board during much of the fraud period, faced impeachment proceedings that were directly influenced by the corruption revelations. The political earthquake generated by these revelations was matched by the economic devastation wreaked on Brazil's financial markets. Petrobras's stock price collapsed by over 60% between 2014 and 2016, wiping out more than $80 billion in shareholder value. The construction companies at the heart of the scheme saw their market capitalizations evaporate, with Odebrecht alone losing over $15 billion in enterprise value. For Banco do Brasil, the reputational damage proved even more costly than the direct financial losses from fines and legal settlements. The bank's stock price fell by 45% during the initial phase of the investigation, as investors grappled with the institution's exposure to both the Petrobras fraud and Brazil's broader economic crisis. Credit rating agencies downgraded Banco do Brasil's debt ratings, citing concerns about governance failures and potential regulatory sanctions. The downgrades triggered margin calls on billions of dollars in derivative positions, forcing the bank to post additional collateral at precisely the moment when its access to international funding markets was becoming constrained. International correspondent banks began terminating their relationships with Banco do Brasil, cutting off critical dollar funding sources and forcing the institution to rely increasingly on expensive domestic funding. The bank's loan portfolio also deteriorated rapidly as the construction companies involved in the scheme faced bankruptcy or severe financial distress. Odebrecht alone owed Banco do Brasil over 3.2 billion reais in outstanding loans, while OAS and Camargo Correa had combined exposures exceeding 2.8 billion reais. As these borrowers defaulted on their obligations, Banco do Brasil was forced to write off billions in loan losses, further pressuring the institution's capital ratios and profitability. The bank's international expansion plans, which had included ambitious growth targets for operations in Argentina, Chile, and Colombia, were indefinitely shelved as management focused on managing the domestic crisis. Brazilian federal prosecutors, armed with powerful plea bargain laws that had been strengthened in 2013, systematically dismantled the conspiracy by turning mid-level participants against their superiors. The plea bargains revealed the intricate details of how bribes were calculated, distributed, and concealed across multiple institutions and jurisdictions. Prosecutors discovered that kickbacks were typically set at 1 to 3% of total contract values, with payments split between Petrobras executives, politicians, and the financial facilitators who made the scheme possible. Banco do Brasil executives received fees ranging from 0.1 to 0.5% of transaction values for their cooperation, generating millions in illicit income for corrupt bank employees. The most senior Banco do Brasil executive implicated in the scheme was André Lara Rezende, a former economic advisor who had served on the bank's board during the peak fraud years. Lara Rezende was accused of receiving over 4.3 million reais in kickbacks in exchange for ensuring that Banco do Brasil continued processing suspicious Petrobras-related transactions. His arrest in 2016 sent shockwaves through Brazil's financial establishment, as Lara Rezende had previously been considered one of the country's most respected economists. The investigation also revealed that several Banco do Brasil branch managers had actively solicited business from construction companies by emphasizing the bank's ability to process transactions with minimal compliance scrutiny. These managers received performance bonuses based on the volume of international transfers they processed, creating perverse incentives to ignore obvious red flags in client transactions. The international dimensions of the Banco do Brasil case proved particularly complex for prosecutors, as the bank's correspondent relationships with institutions in Switzerland, the United States, and the Cayman Islands had enabled much of the money laundering activity. Swiss authorities froze over $200 million in accounts linked to the scheme, while U.S. regulators launched their own investigation into potential violations of American anti-money laundering laws. The U.S. investigation was particularly threatening to Banco do Brasil because the bank maintained significant operations in New York and relied heavily on dollar-denominated funding. Any enforcement action by U.S. regulators could have effectively cut the bank off from the American financial system, a development that would have been catastrophic for an institution of Banco do Brasil's size and international scope. To avoid this outcome, the bank entered into extensive cooperation agreements with both Brazilian and American authorities, providing detailed records of suspicious transactions and agreeing to implement comprehensive compliance reforms. The cooperation agreements required Banco do Brasil to hire independent monitors to oversee its anti-money laundering programs and to submit to regular audits by international compliance experts. The bank also agreed to maintain minimum capital ratios well above regulatory requirements and to limit its growth in high-risk business segments until compliance improvements were verified by regulators. By 2018, the full scope of Banco do Brasil's entanglement in the Petrobras scandal had become clear through court filings, regulatory settlements, and congressional testimony. The bank ultimately paid over 2.8 billion reais in fines, legal settlements, and compliance costs related to the investigation. More than 30 current and former Banco do Brasil employees were criminally charged, with sentences ranging from house arrest to over 12 years in prison for the most serious offenses. The bank's business model was fundamentally transformed by the scandal, as new compliance requirements and regulatory oversight made it far more difficult to pursue the high-margin but risky international transactions that had driven much of the institution's pre-crisis profitability. Banco do Brasil's return on equity, which had averaged over 18% in the years leading up to the scandal, fell to single digits as compliance costs rose and lending opportunities contracted. The bank was also forced to exit several international markets entirely, selling its operations in countries where regulatory requirements made continued operations economically unviable, given the enhanced scrutiny the institution faced. Perhaps most significantly, the scandal fundamentally altered the relationship between Banco do Brasil and the Brazilian government, its controlling shareholder. New governance requirements mandated independent board oversight of government-related transactions and established clear protocols for managing potential conflicts of interest between the bank's commercial objectives and its role in government financial operations. The Banco do Brasil case stands as a watershed moment in the global fight against financial crimes, demonstrating how even the most established and seemingly reputable institutions can become corrupted when proper oversight mechanisms fail. The scandal revealed fundamental weaknesses in Brazil's financial regulatory framework, particularly the inadequate supervision of government-controlled banks and the insufficient coordination between financial regulators and law enforcement agencies. International observers noted that the case highlighted the critical importance of robust correspondent banking due diligence, as many of the scheme's most damaging transactions had been facilitated through relationships with foreign banks that failed to adequately scrutinize their Brazilian counterparts' business practices. The investigation's success in achieving meaningful convictions and financial penalties also demonstrated the effectiveness of Brazil's enhanced plea bargain laws and the crucial role that international cooperation plays in modern financial crime investigations. For Banco do Brasil itself, the scandal marked the end of an era of rapid growth and limited oversight, forcing the institution to rebuild its reputation through demonstrated commitment to transparency and compliance. Today, nearly a decade after the investigation began, Banco do Brasil operates under significantly enhanced regulatory supervision and has implemented compliance programs that are considered among the most comprehensive in Latin America. The bank's experience serves as a cautionary tale about the catastrophic consequences that can result when financial institutions prioritize short-term profits over long-term integrity, and how even the oldest and most prestigious banking names can fall victim to the corrupting influence of systematic fraud.